This content is purely educational and based on my own experience. It should not be considered financial advice. Please do your own research and consult a qualified financial advisor before making any investment decisions. Remember, past performance does not guarantee future returns, and investing always carries risk. Investing in mutual funds can feel overwhelming when you're starting out. With hundreds of schemes available, each promising different benefits, how do you decide which one is right for you? The truth is, choosing your first mutual fund is less about chasing returns and more about understanding yourself, your goals, your risk appetite, and your discipline. This video will walk you step by step through the process of selecting your first mutual fund, covering everything from clarifying your purpose to evaluating fund managers, ratios, and portfolio reviews. Before you even look at a fund brochure, ask yourself, why am I investing? If your goal is long-term wealth creation, equity funds may suit you. If you want safety and stability, debt funds are better. If you want a balance of growth and safety, hybrid funds combine equity and debt. Beyond these basics, there are thematic funds focused on sectors like technology or healthcare and international funds that invest in global markets. But here's the catch. As a beginner, don't jump straight into complex or niche funds. First, get comfortable with market volatility. Just like in your profession, expertise takes years. Investing requires the same patience. Don't get excited and pick a random plan without understanding your purpose and risk appetite. One of the first decisions you'll face is whether to take professional help or manage investments yourself. Working with an advisor gives you expert guidance, saves time, and helps you stay calm during market volatility. This is best for beginners who don't have time to study markets. Doing it yourself gives you control and independence, but it requires effort. You'll need to learn basics like NAV, SIP, expense ratio, and benchmarks. Define your vision clearly. Are you investing for 3 years or 20? Practice discipline. Start small with SIPs and keep learning continuously. Think of it like driving. With an advisor, it's like hiring a driver, safe and convenient, but you rely on them. DIY is like driving yourself. More freedom, but you must learn the rules, practice, and stay disciplined. If you're new and don't want to rely on an advisor, stick with well-established mutual fund companies. They have decades of experience, proven track records across market cycles, and strong compliance and investor protection mechanisms. This reduces the risk of mismanagement and gives you confidence that your money is in safe hands. If you're finding this helpful, don't forget to like and share. It keeps us motivated to bring you more.
Numbers tell the story of a mutual fund. The expense ratio shows the cost of managing the fund. The Sharpe ratio measures risk-adjusted returns. Higher is better. Alpha shows extra gains compared to the benchmark, while beta shows sensitivity to market movements. Standard deviation reflects volatility of returns, and trailing 12-month returns show how the fund performed in the last year. Always combine short-term returns with 3-year and 5-year performance to judge stability. Every fund manager has a unique style. Some are aggressive, some conservative. Check if the manager has been consistent over time and study the investing philosophy. If the manager changes, give them a chance but monitor closely. Remember, you're trusting someone to take care of your money, so their style matters as much as the fund itself. Investing doesn't end once you buy a fund. Review your portfolio at least once a year. Check if the manager is the same, if the style is consistent, if returns are in line with expectations, and whether the expense ratio has increased significantly. Switch only if fundamentals change, not because of short-term market falls. Mutual fund investing is not just about numbers, it's about psychology. If you keep switching funds whenever markets fall, you'll never build wealth. Patience, discipline, and conviction are the keys. Begin with SIPs, small, regular investments that build discipline. Observe volatility, learn to manage emotions, and increase gradually as your confidence grows. Stay consistent with your plan and avoid impulsive changes. Wealth is built by habits, not by chasing quick wins. Choosing your first mutual fund is about clarity, discipline, and patience. Don't chase returns, don't panic during downturns, and don't ignore the importance of reviewing your portfolio. If you're unsure, consult a financial advisor. If you're confident, stick with established fund houses, learn the key ratios, and trust the process. Mutual fund investing is a journey, and the first step is the most important. Mutual fund investing is a journey. Share this video with a friend who's starting theirs.